think back about your life before that and how hard you worked to get to where you are, and, be glad that you did that work. And also, what did your life look like at the time? And are you creating a life that you're happier or more satisfied with today? I think keeping all of those things in perspective is critical, because we can so easily forget what the past was like, whether for others that came before us or just for ourselves in our own lives. And bearing those things in mind is super important when it comes to satisfaction with our lives.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hennche. Welcome back to The Path to Wealth. I'm your host, Hennche. Today we have the pleasure of having Taylor Loht as our guest. Taylor is a thriving investor in multifamily and self-storage and the founder of Untitled Capital. With properties located in Arizona, the Carolinas, and Texas, he has skillfully navigated and collaborated on real estate investment deals totaling over $350 million. Through his podcast, The Passive Wealth Strategy Show, Taylor shares insights on how individuals can break free from Wall Street and cultivate wealth on Main Street. In today's discussion, let's explore the world of value-add multifamily investing. Welcome to the show, Taylor.
Thanks so much for having me. I'll tell you, man, your voice is so relaxing. I'm going to be so chill for this interview. I love it.
I like that. Maybe I should start recording some meditational sessions.
I love it. Do it.
So, Taylor, where did your money mindset start? Is that something that was organic to your family or something that you had to really wrap your head around over the years?
That's an interesting question. It all starts somewhere, and then I think we evolve as we grow and do more in our lives and learn about what's important to us individually. So for me, kind of the first things that I remember are, I had kind of BS jobs when I was in high school, as I think anybody else does. If anybody out there remembers Sears, for example, one of my jobs in high school was working at Sears. I worked at a grocery store, these hourly wage type of things that didn't pay very well, but that was my first kind of foray into making some money and realizing, frankly, how hard it is to make money when you're trading hours for dollars and when you don't have like a skilled position type of thing. So that was my entrance into, okay, it stinks to trade your hours for dollars. I need to find a way eventually to make my money work for me. And at the time back then, this is before the Great Recession, when you could get interest in your bank account. You can again now, but for the longest time, the past, 10, 15 years, you haven't been able to. But back then, all I knew was make the money, put it in my bank account where I was, I think, making like 5% or something like that. And that's what it was. Then I went to college, I got a degree in chemical engineering, got out, started making what I say big boy money, still not a ton, but doing okay. And I said, okay, I have more money to set aside every month. I need to build my skill set basically. And what are successful people doing? And at that time, the most successful investor that I was aware of was Warren Buffett. And he got his strategy from Benjamin Graham. There's this book. I have a copy behind me on the shelf back here, The Intelligent Investor. So that was the first book that I picked up and read about investing generally. It teaches you about value investing. So that's kind of where I got started as an investor, investing in the stock market, index funds, and really maintaining my expenses essentially so that I would have enough left over to invest as much as I possibly could. And that went well for a few years. And I was growing, but I was seeing that I was still fundamentally limited because my ability to grow my investments was driven by my earnings, as it always is. Then I started learning about real estate and how real estate investors create value in their investments. Prior to learning how real estate investing really works, I thought you just go on the MLS, you buy a property, put 20% down, and just wait 30 years for it to maybe appreciate, and hopefully you cash flow throughout that hold period. And that's a valid strategy. You can make some money that way, but still limited. And then I went on to learn how real estate investors look to buy at a discount. They look to buy distressed assets and add value to them by raising their incomes and fixing them up and everything, and either refinancing or selling down the road. So for me, my investing journey has really been a matter of starting with a particular goal and skill set, if you will, and toolbox, and then growing that toolbox over time to better fit with my long-term goals. And of course, your goals change and grow as you earn more money and build more wealth. But still, to me, it's all about having your long-term goal in mind and looking to grow your toolbox so that you can set your investments up to be consistent with those long-term goals. And that's what I've done.
So how do you feel your long-term goals have shifted between like your first investment and now?
How have they shifted? So, well, I think I look at it in terms of life events. So when I first really started investing and read the book, The Intelligent Investor, I was in my early 20s, right? So I didn't have a family at that time, didn't have a wife. So my goals were really, what do I want? What does Taylor want in his life? And frankly, at that time, my goals didn't necessarily include things like getting married. It wasn't on my radar at that point. But last year I got married, right? And we're looking to grow our family moving forward. So, my goals shift with regard to my changing and growing and improving, if you will, life circumstances. So, for example, I was talking with somebody, I remember talking with one of these infinite banking type of whole life insurance folks in my probably mid 20s. And my main rebuttal to them, I'm not an infinite banking guy, just for the record, but my main rebuttal to them was, I'm in my 20s. I don't have any kids. I just don't really feel the need to have this big, expensive whole life insurance policy, because if I were to kick the bucket tomorrow, I just don't have any liabilities to pay off other than having a mortgage at the time. And I had enough cash to cover it or other investments to pay it off. So it wouldn't have been that big of a deal. But now, as I'm in my mid 30s, right, and I'm married, that affects how I look at my long-term wealth creation, look at the value of cash flow. For me, that also increases my time horizon considerably, and just how far out I look at my financial goals. Then, of course, there's also the lifestyle side of things. I was single in my 20s. I didn't mind working as much as I possibly could, right? But now that I'm married and looking at a future where there will be children in the mix, there's an even greater value on my time, right? Because I need to have time available to allocate to family, which is really the most important thing. So for me, and I suspect for most people, it comes down to how your life changes over time in the moment affects how you evaluate things in the long term. And those are the factors that have really, frankly, just expanded all of my long-term goals in I would say, the most positive ways.
Yeah, it sounds like a very sensible progression. We have all of those ideas in our 20s of what life is like or what's important, and then as we go through the loops and the years, it kind of sinks in that maybe there's other things more important, more relevant, and time becomes so much more valuable to us. Like, especially, I guess, the minute we start experiencing the loss of people around us, which is like the natural progression in age, it becomes so much more obvious. I'm like, hey, okay, maybe 80-hour work week just to make something happen is not the end goal here.
Yeah, I definitely would agree with that. And, you bring up something very relevant about people around you passing away. And you see my grandfather passed away 4 or 5 years ago. It's, interesting how you kind of forget the year they pass away, but he was in his early 90s, and he had retired maybe 25 years before he passed away, something like that. And statistically, when people retire, especially if they retire early, he didn't necessarily retire early, depends on a matter of perspective. But when people retire early, they die earlier, and he didn't die earlier. And I think a lot of that has to do with how he had a farm. He continued to work on the farm. There were
That's it. Yeah.
one of my uncles had put out a a trail cam just to like watch for deer and bear and wildlife and stuff like that. And at one point there was a picture that was taken of my grandfather when he was probably 88 or 89, walking through the woods with a chainsaw in his hand because he was out cutting down trees to heat the house. And, I think a lot of folks tend to look to create a financial situation where they can quit working and just go retire and sail off into the sunset. And you talk with people who did that and they get unhappy very quickly. They get bored very quickly. Now, it's not to say that's not a worthwhile goal. Of course it's a great goal. But once you get to that point, I think you have to keep yourself engaged with the world or engaged with things that have meaning to you, and it creates a better well-being in the long run. And, you live longer and have a happier life in general, better relationships with people. So yeah, keep those things in mind.
I think the farm and like having that outdoor activity is the true game changer. I think if he would have retired and just sat down in his chair and maybe, I don't know, looked out over the porch, it wouldn't have gone that well.
Oh yeah, absolutely. I mean, he, just for a little more background. So I mentioned he was cutting wood to heat the house, and he did that his whole life. They got he had a gas heater for their home. My grandmother is still alive, fortunately, all these years later, but he had a gas home heater installed a month before he passed away. So he was out chopping wood, cutting wood, and he would get help from my uncles and cousins. And I lived further away, but I would go and help from time to time. But a month before he passed away, other than that, he was still working and out and gardening, and he would go out and, they lived in pretty rural part of Pennsylvania. He would take a folding chair outside at night and just sit it in the driveway and look up and watch the stars. I mean, how many of us really do that? I'll be the first to admit I don't really do that consistently, but, yeah, I mean, I look at especially the later years of his life and how he lived, and I think there's a lot of wisdom in that, and that's probably why he made it so long. So, yeah.
Yeah. It almost sounds like he knew, like, put in the gas heater 1 month.
Yeah, it's like, yeah,
I can't keep heating with wood because I'll be gone, so let's put in the gas heater.
He might have. It's hard to say. We can't ask him, but yeah.
Where is it? I mean, the only really rural town in Pennsylvania is Punxsutawney.
They live outside of Lewistown, Pennsylvania. It's kind of probably half an hour, 45 minutes from State College, where Penn State is.
Yeah. A friend of mine had like a 500-acre farm there, and it was beautiful. It was beautiful, but it was just so far away from anything. And I'm like, it's exciting when you're there, but then you're like, what am I doing out here? Like, there's nowhere. And we were thinking about what can we do with the real estate of the farm, like, oh, we can throw, I don't know, maybe we can rent it out for weddings. I'm like, nobody's driving 5 hours to get to this place just to celebrate the wedding. They will go somewhere closer to New York City, for example, 2 hours or something. Like, you need to build a real destination location in order for people to go out there and celebrate. So then we were thinking, okay, maybe a festival ground, and we had all kinds of different ideas. Meanwhile, he was making use of the timber, and he was growing some Christmas trees and stuff. Then he rented out a large part of the fields, and he eventually ended up selling it to the local farmers, and basically took the 500 acres apart into different pieces and found different suitable things for it. But like a couple of years, we were just trying to think of what's a good real estate use here? Like, what can we do with it? But then also, if you're not willing to move there, live there, and it's limited. Which kind of reminds me of, it's important where to buy. So what is your thesis on location, and why did you pick the Carolinas? Arizona, Texas is.
Sure. Yeah, it's so important in real estate investing. And like you mentioned a bit earlier, I invest in multifamily and self-storage, and it starts with, you need people to be there. And why are people in any given area? Well, that comes down to local economies and jobs and things like that, because people, generally speaking, move to where the jobs are. So we like to look for markets that have strong local economies, that have population growth, that have job growth, that have not excessive new housing coming online, new housing development, because that's essentially competition for those of us who already own housing in those areas. I'm also a big fan of things that are a little bit softer metrics, if you will, meaning like economic diversification. So if you're in a given market that has a handful of major employers, well, that can represent a pretty significant risk to property owners. And we actually learned this in the beginning of COVID in a property that I owned at the time. This is in Amarillo, Texas, and we no longer own that property. It did work out, but the big lesson there was there were a small number of major employers in that market, and they temporarily did furloughs and layoffs and shutdowns because of COVID, especially early on. And that was a big concern for us because, okay, how many of our tenants work at those employers and how is this going to affect our cash flows? And it ended up working out, but still that underscored the need to focus on having an understanding of the exposure to individual either industries or employers and how that affects your investment. And in my opinion, my experience, most larger markets, what you might call secondary or primary markets, have enough employment opportunity. So one employer going through difficulties, if you will, or layoffs or everything, doesn't have quite as big of an impact as, at least at that time, because Amarillo is a smaller city, so there are fewer employers there. So looking for larger markets generally, most areas will have more economic diversification, so it's less of an issue. But yeah, I mean, it really starts with the economies and making sure they're in good shape, and then you go on to things like landlord tenant friendliness, very important. I wouldn't invest in many states that are just too tenant friendly, make it very hard to evict people for non-payment, and things along those lines. But starting with those market metrics first.
Yeah. This is why we also like to know where our tenants work, right? There's always these questions like, employer. And then oh my God, 50% of my apartments are tied to this one business doing well.
Yeah. And I think when you're in bigger markets generally, that's less likely because there's not, there aren't one major employer in most major cities. But if you're in a smaller city, you're more likely to have that risk. So it's something to think about for sure.
Yeah. I mean, I think definitely you want to be well diversified in terms of the options of where your tenants come from in that, like you don't want to be across the street from a military base that's about to shut down.
Yeah, 100%. And there were, over the years, there have been shutdowns like that really drew down the number of prospective tenants in any given city. When you have a shutdown of the government or some kind of budget sequestration, which was more common in the early 2010s, it's just, it's something to think about. I mean, so I live in Virginia, I'm in Richmond, and we have the Tidewater area, which is, has a lot of military presence. But and I don't really see that going away, but in a hypothetical sense, if there was a reduction in force or something like that, I would be personally concerned about the impact on the overall local economy and how many of your tenants' employment is really tied to the activity of the local military bases. So it's worth considering for sure.
Yeah. I was listening to a Ken McElroy episode, and he had a property very close to a power plant, and a large chunk of his tenants were employed by the power plant and the power plant manager. Ideally, I mean, those are things that you can see coming. It will be harder to offload the asset because somebody else will know too that a major employer is going out of, for example, with military bases and large scale power plants. Those things don't happen overnight. There's usually a phase out plan. So ideally, this is a component that we can keep in mind, and where we have, like, we're right now thinking about investing in an area where the biggest employer is actually healthcare by far, and it's an individual healthcare system just based on the kind of the retirement age group that has all of those healthcare needs, And then if you go down the rest of the 10 biggest employers in the area, there's not like some major influx here, but we still think that there's like a 10-15 year window to have a very solid population growth and job growth on a secondary level based on baby boomers moving in. And that's kind of my thesis on it. And that's what we're looking for, is like that if I can say for the next 10 years, we will have some steady growth, that's when I get curious and interested and I dial down. But what's your thesis on that? Like, what's the time frame that you need to look at a certain area to be comfortable to deploying money?
So generally speaking, the hold periods that I'm comfortable with sticking with or committing to, if you will, are along the lines of 5 to 7 years. So I want to feel confident about the economic growth to that period or a bit longer. And I don't think anybody can really project those things in any given area with a whole lot of confidence if we're really, I think, trying to be objective, because there are things like black swan events that can happen that nobody sees coming. I mean, very few people outside of Congress, for example, saw COVID coming. But yeah, I mean, I would want to be comfortable with the long-term growth for at least that period of time. But there are a lot of other factors that come into play there. You could think about the local and state governance. Are they governing the state and the city in a way that you have confidence in, if you will, in that period of time? And those things change, right? Administrations kind of come and go, but do they take a shorter term view? Are they blowing out their local budgets or, what have you? There's a lot of factors to consider. But I think when you come back to things like job growth and migration and diversification of the industries, you're putting yourself in a better position to have that confidence in the 5, 7, maybe 10-year time frame.
Mm-hmm. Earlier, you mentioned that markets that have new inventory coming up, put a little bit of pressure on people that own existing inventory. There is a lot of inventory hitting the market in 2024 and maybe the first quarter of 2025. What's your take on that next probably 12 to 18 months in regards to so much inventory hitting the market?
Yeah, I think it's definitely something that folks need to consider. I mean, all markets are different with regard to the amount of inventory coming online and how much that's going to increase the overall supply in any given area on a maybe percentage basis or what have you. Every market is different, but it's definitely something to pay attention to. I mean, if you're looking at holding a piece of property for 5, 7, 10 years, whatever your time frame is, then I think it makes sense to really take your time when you're getting into a market or a property and make sure you're confident in that decision. And if you see a lot of new supply coming online in the very near future, then, you can use your judgment and maybe decide to hold off or focus on a different market. But that competition very well may impact your ability to get certain rents or your ability to be attractive to your particular tenant pool. So it's definitely something to think about. And just while we're on the topic of metrics, I think one thing that I don't see people talking about often enough, and I kind of say this because nobody was talking about it that I heard when I was first getting started investing in multifamily, is this just the topic of the age of your property. And this is important in light of the discussion about new supply coming online. Personally, I no longer invest in or buy properties that were built in the 1970s or earlier. And I've owned properties built in the 60s and 70s, and they were generally lower rent, C-class properties that were fine, but the likelihood that in a property that old that you're going to find skeletons in the closet, if you will, and have a big CapEx item or a bunch of them is pretty high. And that I found that consistently. And you can talk about A, B, C class all you want, but that's a little harder to quantify. Oh, what's a B plus what's a B plus versus an A minus, or a B minus versus a C plus? It's, that's a little bit of a judgment thing, but I think it makes sense to have figures in that regard, like a number, right? So that's why, again, just based on experience, I wouldn't anymore buy a property built in the 70s or earlier. They're just getting too old. And even then, 80s is a bit case by case basis. What condition is the property in? But that's, you have your best ability to make decisions before you buy a property, and the decision to buy versus not buy, I think you can use the most data and judgment in. Once you own it, you have a much more limited number of decisions that you can make, whether fixing something up or selling it off or what have you. So think about the age of the property you're investing in and how that might impact the cost to operate it or the cost to fix it up over time, especially when we're talking about new inventory coming online. Well, your property built in the 70s as compared to something that's coming online in 2024 or 2025, you're probably not competing for the same tenant pool because the new property is going to have much higher rents than your property built in the 70s, but they're still in the same overall housing supply. So if the folks that are maybe targeted to live in the 2024, 2025 build or 2023, whatever, build properties, if they move out of properties that were built in the 20 teens or 2000s, that creates more vacancy and more ability or more drive to attract tenants from the lower end, right? So that generally could affect rents in the cheaper properties. So, just things to think about, but think about the year built of your property and how that will impact performance over time.
Yeah. In that case, I feel like everybody is moving up, like there is on the upper end of the income spectrum, they always like new inventory. They like the shiny, new build. And then the property that they used to be in might get a slight discount. So somebody, one income group below might be like, okay, we can move here. It's a little bit nicer. We've worked hard the last couple of years. Let's treat ourselves to this. And then the other property basically trades you're probably getting around 40 to 50% less in rent than you're getting on the premium property in the same market.
Yeah. I mean, that additional competition, especially if you're in an area or a time frame where the economy is starting to slow down, it could really impact, I think, the C-class side of things a lot harder. So, yeah, I think not a lot of people were talking about the ages of properties enough. So that's why I'm, kind of beating that drum a bit more.
I think especially when it comes to wiring and piping, there's some things, pipes especially, that can be a real headache. Rooftops occasionally. I mean, we've invested in a deal 5 years ago where the due diligence, missed the rooftop.
Wow.
And that's a big ticket item, 2 years in.
Yeah. Yeah. To me, the roof, it's, unless they miss it, of course, the roof is a little easier to see, right? You can go and look at the underside of the roof, look at the deck and see what condition it's in. You can kind of figure that out a little bit better, and you have to price that in and everything. But things like plumbing, I mean, I've had major plumbing failures in older properties, and you can scope lines and things like that, and that can help. But still, I just think you're, in a lot of cases, running on borrowed time on older plumbing. And so, yeah, absolutely.
Yeah, last week I had this theory that either way you'll pay. I'm like, you can pay the premium up front and sleep well, or you can kind of, borrow time, as you said, and you go with it, and you might be the one that's falling down on it, So either way you pay, like you pay the premium or you'll pay the fix. But I think over a long enough time horizon, you will have to pay your dues.
That's right. And the fix, they're both expensive, but the fix is more expensive in my experience. You're oftentimes losing out on rent because if people don't have plumbing, you got to give them somewhere else to live, it's just a big headache because it's a disruption, and you have to come out of your CapEx budget that maybe you meant to spend on new countertops or floors or what have you. So yeah, figure that stuff out up front for sure.
I mean, especially if you have to get into the CapEx budget that was meant to actually do value add, but then you're just fixing something that has to be operational. That's like you cannot turn around to the tenants and be like, "Hey, we've
We
improved
fixed
the
the plumbing.
property."
You should pay more rent. No, it's not going to
Yeah,
work.
it doesn't work like that.
Nope.
So I mean, ideally, when you sell, you can turn around, you can tell the next buyer, "I'm like, hey, here, this is a big thing we just fixed already. You can sleep well on that one, but can't raise the rent on it."
Yeah, at the end of the day, they're looking at your NOI and the prevailing market cap rate, and that's what, a buyer would be willing to pay. And fixing your plumbing, yeah, if you repair a major leak or something like that, that could maybe improve your NOI because you may reduce an expense a bit, but that's a bit tougher. You're probably not going to make that money back. And yeah, buy right in the first place is really what it comes down to.
Yeah. So what's your personal sentiment on multifamily market? Kind of looking at 2024, early 2025, we actually have a lot of inventory coming, but having the perspective of inventory missing, it's actually not that much. So where do you see the overall market moving? Also, kind of taking interest rates into consideration.
Yeah, I think to me, interest rates are the bigger factor there more broadly because, again, not every market has all of that new inventory coming on to the same level, right? Some markets have more new inventory coming online and, it's a little harder to predict in that way. But really what we see now, and it's not hard to find articles about this stuff, are a lot of folks struggling with the increased interest rates. And that's for the most part due to variable rate debt that they got with shorter term interest rate caps that are either running out or already have run out. And there have been some pretty major foreclosures. And it's really unfortunate. I don't want to see anybody lose money in these deals, but it's happening. It's not that difficult to find, again, articles on various websites about that happening and folks losing properties. So I think for the opportunistic investor that's looking for those opportunities, there are ways to capitalize on that distress. And we've done deals and have bought properties from folks who got overextended and bought at the market highs in 2021 with really low rate debt and short-term rate caps. And then they are basically forced to sell and you can get a pretty strong discount to what they paid in 2021. So I think a lot of those folks who are in trouble today because of today's interest rates versus where they were a couple of years ago, they know it. They're really aware that they're in that situation. So, if you're somebody that's in a position that wants to be able to, for want of a better phrase, take advantage of that or to capitalize on that opportunity, it's there, right? You just have to understand what you're getting into. I mean, a lot of those companies maybe weren't operating their properties very well, so there might be CapEx items that they haven't done or deferred maintenance, things like that. But I really see folks struggling more now with the rates of today than things like this new supply coming online. And the new supply coming online is a bit into the future. We'll see how that affects things. I would say overall, I'm still an investor. I'm still investing in deals today. We're still doing deals, but I think you, even more so now than before, need to really be aware of what you're getting into and be investing in areas that have these strong economies. I'm working on basically a newsletter for my list because there are a lot of folks today saying, oh, that we're going to get such a number of interest rate cuts this year. And I'm not so sure that I agree with that take that we're going to get 100 rate cuts or whatever in 2024. I mean, we might, but the Federal Reserve's job is to maintain a stable price level, which is they've interpreted to mean modest inflation, 2-3%, something like that, and maximum employment. Well, employment numbers are still strong, or at least the numbers that they're reporting. I know a lot of folks disagree with that, but they're still seeing strong employment numbers. And then they're saying that inflation is still running a little bit hot, not crazy hot, but a little bit hot. And again, there are folks who will dispute both of those figures, but I think we should at least take them at face value in the sense that these are the numbers that the Federal Reserve is basing their decision on. And those numbers are still not in line with the Fed cutting rates within the next couple of months. I know there are a lot of people who want the Fed to cut rates within the next couple of months because it would
They're
be
actually
good for
praying for it every night.
Right, exactly. And it would be good for me too. I'm not denying that it would be good for me too if rates were cut. We'd probably have the opportunity to refi stuff, and I wouldn't complain, right? The cheap money would be great. But to me, the predicting that there are going to be X number of rate cuts this year, still preliminary. And until we start to see some of that data turn, I wouldn't expect rate cuts. And I think just a month, maybe 2 months ago, there were all these articles published about how, the consensus was I don't remember the exact number, but 90% chance or 95% chance of rate cuts in March, or they were all certain there's going to be a rate cut in March. And then here we find ourselves at the end of February, and they're all saying, it's 50-50 if we get a rate cut in May. So let's back up. We were saying almost a dead certainty we were going to get it in March, but now we get to revise and, no, we're going to forget about that one. We're going to say, we're pretty sure about May or whatever the next term they're saying is. But I think we need to take a step back and see the trajectory of that projection changing, right? They're kind of pulling back from that projection of rate cuts happening in the near future. So I think we might get rate cuts this year. I think it'll be a little while until we do. And if they start to happen, we'll probably see it coming. Maybe, banks start to fail again, or inflation starts to really dive, and then they need to get inflation going again, or we get a heat up in unemployment, right? A lot of employers firing people or laying people off. I mean, I think it'll be pretty obvious that it's coming when it's coming, but right now, to me, it seems preliminary.
Yeah. Sounds like higher for longer.
Quite possibly. It's really hard to say. And a lot of people say, we got this election year coming up. They love to cut coming into an election, but the Fed's not supposed to be political. They're like, one of their number one jobs is to not be political. And so they're not supposed to do that. Now, whether that means they won't hike this year, I think is probably reasonable. They won't want to upset the apple cart too much, but we're talking about, in this case, the prospect of cuts, which I think are not forthcoming in the next couple of months. Personally, that's what I think.
Actually, now that I'm listening to you, I think it's a very fine line, because if you lower, you might risk driving inflation. If you raise, you just I think the sentiment in general is going to be negative. So if you want to be kind of unpolitical about it, you just wait till November and you don't do anything.
I think that's the not changing anything is probably the most neutral decision at this point. And and like I said a little bit ago, I think if they're coming, it's going to be pretty obvious that they're needed. I mean, in my opinion, the Fed was at least 6 months too late in starting to raise rates when they started to raise rates almost 2 years ago now. And so they're always a day late, maybe not a dollar short on these things, but they're always behind the eight ball. So when it comes to starting to cut again, if and when they do, I think it'll be painfully obvious that it's coming, and it won't be, maybe we'll get it in the next couple months. We'll see it coming.
I think some of them has to do because the way they collect their data is not exactly real time. Like, it's not that they tap into credit card processors and see what the economy doing in real time. They have like these really outdated processes where there's actually people going out in person with tablets, which is already the upgraded version from paper, but they're asking business owners how their business is doing. And so instead of maybe going into the payment infrastructure and seeing how's money moving today, and like, where is the trend, like how is the consumer doing, how the business is doing, I think there's a real lack in data that they haven't picked up to. And every time I walk into government offices, I'm kind of reminded that they almost live in a different age. Like, it's literally, man, You mentioned that you got married last year, so you probably went into uh, a couple different government scenarios where you're like wondering. I'm like, this seems so outdated, and the people that are sitting in some of those offices, they're government employees, which means they were looking for security and not necessarily like the most impactful job, you know. Um, so it also attracts a certain kind of thinking and a certain kind of person who wants these jobs. And I think that compounds through the system and doesn't give you the most efficient data set to work with.
Yeah, no, I think you're spot on there. Can't disagree.
Well, Taylor, one of my favorite questions, kind of not so much about economics and more about life in general, is like, what do you consider a life worth living?
That's an interesting question. I think for me, I'll just only answer for myself. It's about not just dedicating your life to things like just constantly making more money, understanding what for you is enough. And that doesn't mean once you get to that point, just stop and, quit, but what for you is the lifestyle that you're looking for? What's the type of home that you want? And then at what point can you really begin to focus on, uh, maximizing your positive impact to the world? I mean, and in terms of going back to lifestyle, do you have hobbies that you enjoy? And how much time do you have to focus on those things? Not just time, but your energy. So for me, my favorite hobby is Brazilian Jiu Jitsu. I train a few 4 or 5 days a week, and that's my favorite leisure activity. And I intend to do that as long as I possibly can. It's where I meet all my new friends and everything like that. But I think having time and energy and the financial means to have hobbies that you enjoy is certainly valuable. Having the means to contribute to causes that you care about. I contribute to local animal shelters is very important to me. And then of course having people, family, friends around you that you enjoy being around, that you enjoy each other's company, you can, take care of one another, everything like that. Super important. I mean, we've got we were talking a bit before we started recording today about, having perspective on like how great things are, right? We were talking about, flying across the country, flying from Colorado to New York. And we kind of take it for granted these days that, it costs a couple $100,000, whatever, to fly across the country in just a few hours. Whereas a few hundred years ago, people had to abandon their entire lives and take a ship across the ocean and covered wagons and everything like that to a land they'd never even seen a picture of to look for opportunities. Whereas today, I mean, I could buy a ticket right now and be on the other side of the planet tomorrow or 2 days from now, depending on the flight time. So keeping those things in perspective is really relevant, and not just in the broad swath of history, but also within our own lives. I think for me, when I've hit different financial metrics, whether it's income or net worth, I've hit numbers that I hadn't hit before. It's fun and exciting for about a day. And then after that day passes, you get really used to it and you want to look for the next one. But think back about your life before that and how hard you worked to get to where you are. And, be glad that you did that work. And also, what did your life look like at the time? And are you creating a life that you're happier or more satisfied with today? I think keeping all of those things in perspective is critical, because we can so easily forget what the past was like, whether for others that came before us or just for ourselves in our own lives. And bearing those things in mind is super important when it comes to satisfaction with our lives.
How do you go about that? Like you mentioned, you, for example, you have those goals, you work towards them, takes you sometimes years, decades, but then the satisfaction period is like 1, 2 days and it wears off rather quickly. And I think we've all been there, you get that toy, and then once we are adults, the level of what the toy means changes, or we get that deal, or we get that whatever, we hit that money in the bank account. How do you personally feel that you can have a sustainable level of maybe gratitude, appreciation for what you have without Because I think it's so natural to just move the goalpost.
It is. And I'm not against moving those goalposts, right? Once you hit that metric, okay, I got it. Great. What's my next goal in that regard? Do I have, are you going to double whatever it was? Or, I think you can reset that metric once you hit it, but reset it with the mindset that, okay, I got it. What's the next one? But then also going back to things that are more of what I'm hearing this term a lot of, like an infinite game, a game where you're not going to hit a metric. It's just a matter of constantly trying to get better at it. Yeah. So that's why I think things like physical pursuits are so important. And we all have, an arc in our lives where we're at our physical peak and then we kind of down. I'm in my mid 30s now, so I might be getting close to that downward trend. But, for me, it's been, I have this pursuit of getting better at Brazilian jiu-jitsu, because there's always somebody better than you. There's always something new to learn. And I think having something in your life like that, where you can just accept the fact that you're never going to reach some level of Valhalla, you're going to learn something and then find something else you can learn beyond that. And it doesn't, of course, have to be just jiu-jitsu. You could be into tennis or running, or I think that physical aspect, a physical pursuit, at least for me, has been really important. And I think having things in your life beyond just making more money is very relevant, because it's always going to be a trade-off. You're making more money, but maybe you're getting in worse shape. And then you make the more money, it's like, all right, I got to work on getting myself back in shape, or things like that. So looking at life in terms of everything that's going on, not just one area, like how much money you're making, is at least helps me keep perspective on the stuff.
Yeah. I like what you just said, that I think it's Tony Robbins has like the wheel of life, and it's 10 different points, but you'd never hit 10 on 10. No it's way. Like you focus on the money part and you go down on the health part, and then your relationship suffers, and then your family time suffers. And it's like you're trying to keep it well-rounded while, kind of pursuing what means the most to you.
Yeah, 100%. I think that's the right way to look at things, because you're not going to get 10 out of 10 on all of them, but trying to be well-rounded provides better satisfaction.
Yeah. Well, Taylor, thank you so much for making the time. Where can people connect with you beyond the Passive Wealth Strategy podcast?
Sure. If you'd like to set up a time to talk with me, just go to investwithtaylor.com, or we've got a free 7-part video course on red flags in passive real estate investing. If anybody's interested, just go to passiverealestatecourse.com.
Nice. I like those domains, man.
You got to jump on them. You got to buy them when you think of them.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.